Do you want 4 of Australia's best dividend stocks in your portfolio? That's what this video is all about. Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. In this short video and podcast on the Australian Finance Podcast series, I'm going to walk you through 4 dividend stocks that are available right here on the Australian Stock Exchange. These 4, one of them's a ETF, so I was about to say stocks. There's 3 stocks and 1 ETF. These 4 things that you can invest in pay reliable income that pays while you sleep, which is one of the great things about owning shares in Australia, is you can wake up one day and all of a sudden there's some money in your bank account. It might only be a few dollars when you're just starting out, or it might be a few $1,000s as you're growing your money, or a few $100,000 if you've really got it going on. In this video, I'm going to talk to you about why dividends matter, how much dividend is too much dividend, yes, it's a thing, and then give you the 4 different investments. So firstly, what is a dividend? A dividend is just like interest on a bank account, except what you're getting is not something that's guaranteed by a bank. You're getting a share of the profits. Because you own shares in a company like Telstra, for example, if Telstra makes a profit every year, whose profit is that? Well, as the shareholder, you own part of the company. You might only own a tiny, tiny little bit, but it's yours. So you get a little bit of the profit, and we call that a dividend. The dividend appears in your bank account, typically for most Australian companies, if they do pay a dividend, it's optional, about once every 6 months. We call it the half yearly and the full year dividend. And typically the half yearly is a little bit smaller than the full year dividend. But what's key to understand about dividends is they're not guaranteed, like the income that might come from a bank account. And secondly, is that over the long term, the actual dividend amount that you can receive can grow significantly. I've seen some investors buy shares, so say they put $2,000 in some shares, and one day the dividend they receive is actually bigger than the entire investment they made in the first place. And that might take quite a few years to kick off, but I've seen it in real life, and it's pretty impressive when it does happen. So over time, the value of your investment can grow, unlike a bank. So the actual shares can go up, but you can also receive a growing dividend each and every year. So that's kind of like the holy grail of investments, if you ask me. It goes up in price and you're getting more and more income over time. However, there is a third kicker about these dividends that come in Australia. Some of the investments you make in Australia, and indeed some of the things I'm about to mention, come with something called a franking credit. Now, if you're not an investor, you might only have heard of these things called franking credits in the news or in like a political debate or something like that. For now, all I want you to remember is that a franking credit is just a tax credit. So say, for example, you get a $5 dividend, you might have a little tax credit stored at the tax office, the ATO, on your behalf. So when you do your tax return, that little credit either offsets the tax you were already going to pay, or it gets refunded and you get a bigger tax return. So it's pretty good. These are very unique, and Australia is one of the only countries in the world that actually offers franking credits. So by owning shares and ETFs, you can get these things called franking credits. Let's recap. 1, income while you sleep, which is pretty good, and it can grow over time. 2, if you make the right investments, it can grow over time as well. And 3, you may even get some tax credits, aka franking credits. So if this all sounds too good to be true, it may be because in some instances it actually is. There are some really common mistakes that people make, especially when they're beginners, trying to find dividend stocks. And I'm going to go through the 2 most common right now. Number 1 is they just try and find the stocks or shares, it's the same thing, with the biggest dividend yield. So A yield is like the percentage. Like if you get a 10% yield, it means you're getting 10% of your original investment back every year. If it's 5%, you're getting a 5% yield or a $5 return for every $100 you invest every year. People make this mistake. They go for the thing with the biggest yield. It is a classic mistake. And remember what I said before, that dividends are not guaranteed. You don't always receive a dividend. It's up to the company if they decide to pay you a dividend or not. Sometimes they need the money to pay off their loans or just to keep their business alive. So they won't pay you a dividend if that's going to happen. So people make the mistake. They go, oh, look at this big dividend yield, only to find out that the company doesn't actually pay a dividend that year or ever. So when you log into your share brokerage account or your trading app, make sure you're not just searching for the company with the biggest dividend yield. To be honest, anything over like 7 or 8%, the hairs on the back of my neck start to pick up and my spine tingles a little because I think that doesn't sound safe to me. And I'll explain why in just a moment. Number 2 is if you are investing in shares, remember that you're investing for the future. So if you make an investment today, you don't get anything that happened in the past. You only get the returns that come in the future. So if that's the case, make sure you're investing in a company or a share that's going to grow. Right? Now, this often trips people up because they're like, well, don't I want income? Well, you do want income, but you want income that's going to grow over time. So maybe a little bit less income today is okay because that income amount is going to grow over time. And before you know it, you're getting a bigger and bigger and bigger dividend. What I always say to investors is that you can't pay a dividend if you don't have profits. So the only way to get a bigger dividend is to have bigger profits. So seems pretty simple to me. Focus on the company that's going to get the bigger profits. It would make sense, right? Because then you're going to get a bigger dividend. So don't forget about the growth that comes from a company. So the 2 traps are searching for the share or the company or whatever with the biggest dividend. That can be risky. Number 2 is actually forgetting about growth altogether and just thinking, well, it might not be what Owen said, which is like 7 or 10%. It's not risky like that. So you go with one that's 5%, but the 5% isn't growing. Remember, you want the one that grows as well as pays a high amount. So those things are said. I want you to remember this analogy that I like to use. Imagine you have a seesaw, like you would in any park. There's something on one side and something on the other side. On one side, we have growth, and on the other side, we have the income or the dividends. What people tend to forget is that they tend to go all growth or all dividends. So it's like the seesaw's gone to one side and not the other. In the middle is whatever is keeping it afloat. We call this the total return. So if you added both together, you get the total return in the middle. Let me break this down, and this analogy is about to become really clear. Over the really long term, the share market has returned about 10% per year, right? About 10%. So that's that bit in the middle. Now, if you were to go and search for a dividend share that pays you 4% in dividends, the other 6% is sitting on the other side of that seesaw, right? Now, imagine you try and find a share that pays 2% in dividends. Maybe there's 8% sitting on the other side of the seesaw, and we're getting more growth than we are income. And the mistake, this is how it relates to the mistake. People try and go all or nothing, right? But you want a nice balance. So try to find companies that are growing their profits at a steady rate, doesn't have to be a lot, with a nice dividend to boot. So with that said, not all growth, not all dividends, a bit of both, please. Let's look at these 4 companies. So the first one that I'm going to bring to you is actually not 100% boring, but it might seem a little bit. This is Macquarie Group. It trades under the ASX ticker symbol, that's the stock code of MQG for Macquarie Group. Macquarie Group is Australia's 5th largest bank. So CBA is the biggest, and then all the way down in 5th is Macquarie Group. Now, Macquarie is very different amongst the banks. You might see it on a building when you go to one of Australia's cities. You might even see it overseas. Macquarie isn't just the place where you go and get a home loan like most banks are, and it's not where you go and just get a savings account. Macquarie has this whole other division called an investment bank. And this is all the other side of finance that you probably don't know much about. Stuff like when two businesses merge together, who handles that? Or if you're trying to send your money somewhere overseas, how does that happen? That's the type of banking that Macquarie does on one half of its business, and the other half is the mortgages and that sort of stuff. So it makes Macquarie quite unique, and it's actually a global leader in investment banking. But it's right here in Australia. According to my numbers, Macquarie offers a dividend yield of around about 3.3% with some franking credits. But here's the important part. Not only does Macquarie pay a reasonably good dividend, it's not huge, but it's pretty good. It's also a business that has achieved a profit for every single one of the past 50 years. So it's no wonder that the share price is going up, because over time it's made profits and it's paid a dividend. It's kind of like that holy grail we spoke about before. It also offers a little bit of franking credits. So that's Macquarie Group, MQG is the ticker symbol. The next one is something that's going to kind of spin you out a bit. This is actually not technically a company, but we might call it a share for the sake of this video, which is that company or share called CLW. That's the stock code. This stands for Charter Hall Long WALE REIT. There's a lot of words in there. What this is it's actually an investment that owns properties. So I want you to think about one investment that you make into this thing on your stock app, and it owns properties. So I'm sitting here in an office in Melbourne. There's a chance that Charter Hall or this thing owns this entire building, or maybe it owns factories or petrol stations. This particular investment called CLW actually holds a bunch of different properties, over 500 different properties. So if you like the idea of investing in property, but you don't have a massive deposit, but you still want some income and some growth, this could be an option. CLW is the stock code, and it currently trades with a yield, get this, of 6.5%. So pretty good, right? Double what Macquarie offered. The key thing is, I don't expect this to grow as fast as Macquarie, so that's why this one has a higher yield to compensate for the lower growth. Remember that seesaw from before? That's kind of what you get with this. Number 3 is another kind of tongue twister. It's Washington H. Sol Pattinson and Co. Now, if that's hard to remember, the stock code is actually a lot easier. It's SOL, like Sol, SOL. This is one of the companies that has been on the Australian Stock Exchange for the longest, over 100 years. It originally started as a chemist or pharmacy in Sydney, and when two pharmacy owners came together, they decided to call it Washington H. Sol Pattinson after the families that brought these two chemists together. Now, Sol Pattinson has actually grown over 100 years, and now it owns massive chunks of businesses like TPG Telecom or Brickworks, which makes most of Australia's bricks. All different types of companies can be found inside this one big company. And so this business is really well diversified. It offers a 2.7% dividend yield at the moment, but it definitely makes up for that in growth. While this business owns a bit of everything, it seems, it is growing over time. And like Macquarie, it's one of these businesses that has an exceptionally good track record. So it's run by the same family members, the distant family members from 100 years ago are still running this business today, which is just incredible. It's the only one that I can think of where that's actually the case. Now, for number 4 on my list, I promised you something a little bit different. Number 4 is not actually an individual company or share. It's an ETF or exchange traded fund. VHY is the stock code, or ETF code in this case. VHY is actually not one company, but around about 65 companies in one investment. So what happens when you invest in this one thing? It goes and invests in another 60 different companies that pay dividends. Talk about diversification. In fact, I wouldn't be surprised if Sol was in there and Macquarie was in there. So one investment, many different companies inside. This is an ETF or exchange traded fund. It is the most popular dividend ETF in Australia. And we've done separate videos on VHY in the past. What this ETF effectively does is think of it like a big bucket, and inside the bucket can only go companies or shares that pay dividends next year. So the ETF goes and surveys all the investment analysts and smart people out there and says, which companies in Australia are going to pay dividends? You, and you. Okay, you go in the bucket. And then they say to us, everyone else, you can buy the bucket. And so this way, the ETF is very effective at allowing income investors not to have to worry about picking individual shares or companies. They can just go and pick this one ETF. And so VHY currently pays an estimated yield of 5.1%. Crucially, you're getting 5.1% from this one. That's the estimated yield. It's not guaranteed, but because it's so diversified, seems like a pretty good one to me. So just to recap, we've got Macquarie Group, MQG, Charter Hall Long WALE REIT, CLW, Washington H. Soul Pattinson, SOL, and the Vanguard Australian Shares High Yield ETF, which is VHY. Now, final note on these is before you invest in anything, please remember that investing involves risk. By watching this video and listening to this podcast, I haven't taken into account your risk profile, whether you should invest or not, your needs, goals, or objectives. So be sure to speak to a financial planner before you act on this information. If you're watching on YouTube or listening on Spotify, be sure to leave us comments so we can get back to you if you have any questions about these companies. If you're confused about any of the stuff that we talked about in this video, remember, don't act on it, but head to the Rask website where we've got loads of free courses on investing, and also you can read our legal documents, such as our financial services guide. It's FSG. I know finance uses a lot of acronyms, but that's a good one to learn more about what we do. So 4 dividend shares to put on your watch list. If you like this short episode of the Australian Finance Podcast, be sure to reach out to us. We love doing these short and punchy episodes, and we'd love to do more of them on topics that you choose. So be sure to let us know. There's a link in the YouTube description or on your podcast player. Just hit the one that says ask a question. That's it for today. Thanks for watching this video on 4 income stocks to add to your watch list. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.